So, Chris, since I've known you,
Yes, sir.
you have acquired and built what I would call a real estate empire, 77 properties and counting, nearly free and clear. I think 4+ Keller Williams offices.
Right, 4 Keller Williams offices, around 800 agents.
And if I'm not mistaken, several times, if not currently, you're the highest producing revenue Keller Williams offices. Was I accurate in that?
Yeah, we do very well.
But,
I mean, it's not been the best in the last year or two,
sure,
given the market shift, but
yeah,
we're making profit.
But as long as I've known you, you have had a keen eye on investments, on growing wealth, and helping others grow wealth,
yeah,
as part of your mission. So let me just ask you this. What is wealth?
Wealth isn't just money. It's freedom. I define it with the word freedom because ultimately somebody who is wealthy needs to be able to go anywhere they want, whenever they want, on their own terms. And a lot of people get boxed into the what I would call the employment quadrant of the 4 quadrants, Robert Kiyosaki's 4 quadrants, and they get stuck in that employment quadrant where they're kind of working for the man. They don't have the freedom to go and do whatever else they want to do. So a truly wealthy person is somebody with freedom, and that freedom is really critical to wealth building, because that's your big why, is being able to spend time with your kids, being able to go hang out with your friends on your terms whenever you want. I can get on a plane and go anywhere in the world, and I can bring my kids with me. I just went to Japan, took them on a great trip last year to Japan. All the kids were there. It was amazing. But that's what's wealth. That's what's wealth.
I had a real estate mentor in Vero Beach tell me wealth was options.
Yeah, exactly.
It's just options or
Absolutely.
access. He would say that interchangeably,
Sure.
access. And so you've built wealth and widely known for your wealth building around real estate,
Right.
whether your own or helping other people.
Sure.
But you didn't get your start here.
No, I got my start. Actually, I was supposed to be a boring lawyer. And so I applied to law school. I went to Georgetown undergrad, and I applied to law school, and I thought I'd be like a trial lawyer, kind of having a lot of fun. And that never happens. What you end up doing is behind a computer desk, writing motions, doing all kinds of boring legal research.
Glorified paralegal.
Yeah, glorified paralegal, exactly. Doing stuff that honestly AI can do for you now too. So a lot of lawyers are going to have to really up their game going forward. But I did actually go to law school. I also got my master's in business from Georgetown as well. So I got a JD MBA. But what I started doing during the summers is I was working for a big law firm called Hall & Knight, and I started day trading during the day, because I was kind of bored with all the legal mumbo jumbo. And so I remember I had this big Palm Pilot that was wireless.
Yes.
And I would trade on the Palm Pilot. I mean, it would take like a minute and a half to execute the trades. But I would bring it with me so that the law firm wouldn't get upset with me that I'd be day trading during the day. So they would monitor, of course, what we were doing on our computers.
Yes.
So I didn't do it on their computer. I just did it on my wireless handheld. But I made more money day trading than I did getting paid by Hall & Knight.
Now, see, I didn't know that. Okay.
And that was just kind of a wake-up call for me, saying, hold on, what am I doing here? Yeah. Let's follow my passion. I really was passionate about the stock market. Yeah. And it was fun back in the day. We had little adages, always buy AOL, never sell your Dell.
Always buy AOL. Oh my God.
Imagine?
That had a timeline.
Yeah,
on it.
We had a timeline to it. Both of them did. And they both went, AOL went to Time Warner, and then Dell went private, and now it's back public again. So, but those were powerful stocks back in the day. So
How old were you?
Powered the company. Let's see, I would have been probably 23, 24 at the time.
And did you have any mentorship?
I had a lot of mentors, but not one specific mentor. So I had a lot of different people that I would lean on that were friends of the family, or kind of mentors in my business career. So, like, for instance, here in Lakeland, one of my big mentors was Jerry Herring when it comes to like building wealth with real estate. Okay. And so he and I served on a couple of boards together, the Lakeland Downtown Development Authority, things like that. But Jerry always was a visionary for downtown development and buildings. And so when I started buying up and accumulating buildings in downtown Lakeland, I was always running through Jerry and talk to him about them, and he was quite a great mentor for me.
But you didn't have a day trading mentor. You were just getting in there, getting nerdy.
No. I was just kind of doing my thing, learning. Is looking at the internet and learning as I went along, but making money and doing quite well.
Was Jim Cramer the personality then that I know him at? I know him for like mid to late 2000s.
He was a big personality, but he was still trading at Cramer Berkowitz.
Oh.
So what just for the background for those who are watching us, Jim Cramer's company, TheStreet.com, the one that he was a majority stockholder in, he's no longer owns it. He's now just doing CNBC. But back in the day, we're talking 1998, 1999, he was trading at Cramer Berkowitz, and then he'd be a guest editorial column for TheStreet.com, which he founded and started. And then so when I started getting a little bored in law and I started really going into the stock market space a lot, I founded this company called smartportfolio.com kind of out of my dorm room when I was still doing my JD MBA. And it ended up being a hit. So I got really smart people to work alongside me, brilliant people from Georgetown as well, other JD MBAs as well. So my close friend David Fogel was our number 2 in charge of it. And he's since sold multiple companies after that exit as well. So really smart people, Phi Beta Kappa, all that kind of stuff. But what I can share with you is that the sale of the smartportfolio.com to TheStreet.com was very interesting because Cramer, right when we were selling, he was wanting to go full time into the editorial space and get out of Cramer Berkowitz. So when we actually bought us, a gentleman named Tom Clark was the CEO of TheStreet.com. He was doing all the negotiations to buy us, and Cramer was kind of behind the scenes. But then when we got in, Cramer started coming on the editorial floor, started being more visible.
What was that like?
That was cool because Cramer is just like you see him on TV.
Like in real life, that's how
in real life, that's how.
It's not a show.
Unless he just does it when he's in public. But when he is that kind of energy, that kind of intensity, 24/7. I don't know how people put up with him that much because you can only take him in small doses. But he's brilliant, and the guy literally sleeps like for 3 hours a night.
So I mean, he's just wired.
He's just wired for he's wired for sound. And you know who his best friend in the world is?
Who?
Actor Gene Hackman. So Gene Hackman and Jim Cramer would be together on the editorial floor, and we used to have the instant messengers and everything on our computers. And then they'd start blowing up. Hackman on the floor today. Hackman on the floor. So Gene Hackman would come into TheStreet.com all the time.
Where was your office based out of?
Right on Wall Street. I think it was. I don't know exactly the number, but we were right on Wall Street. TheStreet.com. And but I kind of negotiated because I was the principal. I was the owner of the majority of the stock at smartportfolio.com. I negotiated that I could work out of Florida. So I was one of the first remote people they had. And I was vice president of strategy for TheStreet.com. So I'd look at other acquisitions and things like that for about a year. And then my employment contract ran out and I started getting real estate.
What made you shift from your passion in stocks to roll those proceeds from that sale into real estate? Why did you make that?
It was a mistake I made that I will always remember.
Okay.
So once I had a fair amount of money, millions of dollars in my pocket, having sold the Smart Portfolio to TheStreet.com, and I owned about 42% of the company at the time when we sold. I was a majority stockholder. I decided to take some chips off the table, if you will, and not necessarily trade them myself. So I gave $500,000 of cash to this gentleman that was running this hedge fund called Westwood Capital Management. I still remember the name of it. And he proceeded within a year to lose 50% of my capital.
What?
So I went from $500,000 to $250,000. And of course, I had a fair amount of money anyway, but it still hurt. And also, I was a stock guy. I'm like, and I had done my vetting. This guy was great. I mean, but he just over leveraged when he shouldn't have, and the compounded the returns in the wrong way. And so I thought to myself, hold on, wait up. I'm never going to be responsible for my own personal wealth by putting it in somebody else's hands. I got to learn myself how to do things. And so I went on a mission at that point to also learn about real estate investing. Now, I had taken a couple of classes like property law and stuff like that in law school. So I was familiar with unities of title and time title, interest in possession, things like that, and kind of the legal mumbo jumbo when it comes to real estate. But I wasn't familiar with cap rates and internal rates of return and cash on cash returns and debt service coverage ratios, things like that. So I had to just do a big deep dive into that. And I started buying real estate. And this was right around 2000, 2001 when I started buying real estate.
I didn't realize that early.
Yeah, so I started buying real estate that early. And actually bought a building in 2000 at 218 East Pine Street, where we're actually filming right now.
I didn't realize you owned this that
Yeah,
long.
so I own this building, And so I bought a building at 218 East Pine Street. It was rented out, 100% occupied. And within about 2 years, one of our tenants moved up to Atlanta. The other tenant was struggling financially. So I had about 4,800 square feet in 2003 to do with what I wanted to do.
Oh, wow.
And so I went up to the owner of the RE/MAX office at the time, and I said, "Hey, Tony, do you want to go in with me and be business partners? We'll own a RE/MAX office in downtown Lakeland." And he said, "No, buddy." He says, "Good luck to you, but I'm not interested in that." I thought, "Okay, buddy." I approached a couple other brokers in town. "Hey, do you want to come downtown Lakeland and put this real estate office?" And I basically was turned down left and right by everyone. So I thought, "Hey, I'm just going to do it myself."
Yeah.
And so I came across this business called Keller Williams Realty. And my sister was up in Atlanta and she was listing her house with Keller Williams.
Okay.
But at the time in 2003, it was really Keller who.
Yes.
Nobody had heard of
Yes.
Keller Williams here in Central Florida, really. So it was really kind of one of those opportunities for me to just really go out and kind of make it happen.
Yeah.
But so I was able to buy the franchise for Lakeland, Florida, and it's a big franchise area right now, so we have a lot. And then I started gobbling up other Keller Williams offices, and right now we're about 800 agents, and we do billions in sales, and we're profitable and making some good headway.
Wow.
But it all started really with an empty building that I had to fill, and then
necessity.
In the first year, we started with 0 agents. By the end of the first year, we had 80 agents.
That's nuts.
And then we surpassed the gentleman who had turned me down to do the business with. So when we surpassed him in sales, he was a good guy about it.
Yeah.
So. But he had a billboard that said #1 office in Lakeland, and he had to take down the billboard.
I actually have a quick question about the sale to the street, honestly, because I touch a lot on, I work with a lot of entrepreneurs, and there's often a lot of emotionalism around selling your business. At the time, was this just an obvious sale? Was there any?
Yeah, this was a quick ramp up. We were profitable. We had 250,000 free subscribers listening to us twice a day about the stock market. So we had really ramped up this business in a meaningful way. These are all free newsletter, free emails.
Yeah.
And then from the 250,000, we would upsell to a premium product. And that would cover like large cap stocks, IPOs, stock splits, you name it. We were writing about it, and we had really smart people that were doing this analysis and these deep dives. And of course, the stock market was very hot and very volatile at the time too. So this was during the .com boom.
Yeah, this was 1999.
So this is like Pets.com's worth $1 billion, stuff like that. So this is kind of crazy. And we were writing about that stuff and making people good money for sure. And but when we started this smartportfolio.com, I always started it with the end in mind. So it of course was my passion, but we always wanted to have a nice exit. We retained SG Cowan, which is a big investment bank out of New York City, and they shopped us. And so we went on the shopping spree, and we had a lot of suitors. And at one point we had CNET made a very lucrative offer to us, and then their stock crashed, and they changed their offer, which was all stock, which was a very lucrative offer. We're talking three times what we ended up selling for.
Oh, wow.
And then they changed it to a low cash offer, and cash was king.
Yes.
Now the street.com, when we sold to them, the majority was cash, because their stock also had been hit up pretty bad, but they had a fair amount of cash. So they paid us a fair amount in cash. So, but as I say, cash is king, baby. So you take the cash and you smile.
We should go into every venture, every project, every business with the end in mind. Most entrepreneurs do not. They're really become their own worst employers. It sounds like you skipped that mistake for whatever reason. But when you got into real estate, did you have an end or an exit in mind with real estate? Because you've been in now over 20 years.
I didn't have an exit in mind, and I still don't have an exit in mind. The great thing about real estate long term, as with the stock market too, is it's a long-term wealth building enterprise. So if you look at it, I mean, real estate is other people's money or banks' money. So if you have that long-term thought and you're putting something on a 15-year or 20-year amortization, that thing's gonna be free and clear in 15, 20 years. So out of the 77 houses I own, 43 of them are free and clear right now. And then I purposely want to use leverage, intelligent leverage, nothing over leveraged, but use intelligent leverage to juice my returns. And that's what's happening now. But there's so many benefits to owning real estate and also buying real estate. So right now, for instance, there's a huge benefit to buying real estate. which is called cost segregation. So, for instance, if you have a house that's, let's just say hypothetically, it's $350,000. Well, you can't write off the land. So you're going to depreciate of a $350,000 house. Let's say the land is worth $50,000. Okay. So then you're left with $300,000 of depreciation. Now that $300,000 of depreciation, you can do a straight line depreciation of 27.5 years, because it's investment residential property. It'd be 39 years if it was commercial. But the 27.5 years, the IRS right now is allowing you to do what's called cost segregation, which is taking big things in the house, like the garage door and all the appliances, and doing accelerated bonus depreciation on them. And so of that 300,000, you can truly carve out about $100,000 worth of cost segregation, segregating it.
Wow.
And then you get to write off under the new big beautiful bill tax code. Under Biden it was 40%. Now you get to write off 100% of that. So you can really make a lot of money in tax savings if you're buying houses right now before the end of the tax year, because you're gonna be able to save roughly $100,000 in cost segregation, bonus depreciation, that you wouldn't have otherwise.
Now, that sounds super advanced. And when I think about the average investor, that sounds like they would be needing that amount of deduction in order for that to be like a win. If you had $10,000 to invest right now, and that's what you've been able to piece together over the last 6 months or a year, where would you start?
I'd probably do a little 50-50.
Okay.
Well, first of all, the great thing about real estate investing, which I love, is that you don't need to have any money. You don't need to have $10,000. You just got to have the ability to attract capital, or the ability to get the seller to partner with you on the sale of property. So for instance, if I was dead broke, I'd approach a seller with a cash flowing property. Let's say it's a duplex that happens to be, let's just say $300,000 duplex.
Sure.
And each side is rented out for $1,500. So that meets my rule of 1%. My rule of 1% is that 1% of the purchase price needs to be your monthly rent. Okay. And if you do that, you're always going to stay out of trouble, even if you put leverage on the property. So I'm going to do $1,500, that's $3,000. I'm going to get this duplex, and I'm going to go, Mr. and Mrs. Seller, I don't think you want to take all of this into have to pay capital gains on the whole thing. So why don't we do an installment sale on this property? And why don't you hold back 25% of the property as a second mortgage? And why don't you let me finance as a first mortgage 75% with our local bank? And so basically I just walked into this property 100% financed, with 25% going to the seller, perhaps a balloon payment in 5 to 7 years, and perhaps reasonable interest rate. Right now, probably if you're doing seller financing, you want to give them 7% or so at least. And then I'm going to go to a bank, and I'm going to get a portfolio loan from the bank. It's not going to be a Fannie Freddie product, but it's going to be a portfolio loan where they're going to acknowledge the fact that they know that there's second mortgage on the property. They know there's a little bit more debt service on it. But as long as I'm covering my debt service with the rents, which I am, because I'm getting $3,000 a month, it all wins. So I just walked into that property without any capital. Okay, so that's one of the beauties of real estate investing. And I've done many creative deals, not because I didn't have the money, just because I wanted to do something interesting. So
where can the average person get
actually I wrote a book.
Do you cover this in your book?
I do cover this in my book. So I wrote, it's called Chris McLaughlin's Guide to Smart Real Estate Investing.
There you go.
It's on Amazon.com.
Yes.
So if you just jump over on Amazon, you type in my name, Chris McLaughlin, it's going to pull up. It's a really good book. So I wrote a book covering all this stuff.
Okay.
And that book is going to help me also with the Smart Wealth newsletter. So I'm going to be pulling, tip topics like other people's money, second mortgages, cost segregation, 1031 tax deferred exchanges, things like that.
So this leads to a question. What made you re-enter the stocks? So you started with stocks, you parlayed into real estate, it's your playground, you built what I would consider generational wealth and education for all of your employees and friends.
Sure.
Why did you pivot into the new
Well,
stock newsletter?
after I lost, the other gentleman had lost my money, I still was determined to build wealth, but I was just being more selective at that point and kind of also trusting my own instincts. I'd always been a good day trader, and I'd gotten out of day trading, so I didn't really day trade anymore, but I was more of a long-term investor. And so it wasn't overnight, but it was just like, okay. And also I already had stocks. So it's not like I liquidated.
Sure.
I already had them. So I was still playing them. And so I have some stocks like, Microsoft and, things like that that I've owned for just, decades, and they've done great. So,
so you've re-entered the stock game. Are you bored, or what's
no,
going
no.
on?
I think with the advent of AI,
Yes.
and that's why I really love this wealth building newsletter, because I get to tap into my kids' brains. With the advent of artificial intelligence, we are learning so much now that we had no idea that we're even capable of, right? And so Frankie and Tripp keep on giving me these AI stocks. Hey, Dad, check out this,
Man.
whatever.
If only we had gotten on NVIDIA
Frankie,
soon enough.
Exactly. Frankie, it also, it's like, their GEV, the ticker symbol GEV, that's a huge AI play, but through the energy sector. So AI is affecting everything. And it's just a really exciting time to be a stock investor right now.
Peter Diamandis has published a book called Exponential Organizations. And basically, and this was like 7 years ago. And he basically said something similar in the chapter that landed on traditional investments, traditional stock investments. He said, we need to start adding into our value equation of a stock. We need to incorporate into our value evaluation of whether or not they're adopting AI. Yeah. And if that entity, even if it's in a boring business, if they're incorporating AI, they're going to outperform peers no matter what in the coming years, even if they're not brilliant per se. GEV, not financial advice.
Right.
Do your own homework.
Literally, I'm up over 500% on that stock.
That's fantastic.
Yeah, it's great.
And so your two boys are coming up on the age you were when you started really nerding out about some of this. They're both in college. So tell me a little bit about you guys coming together to share your...
Yeah, well, Frankie's still a high school senior.
Okay.
So, and Tripp is a junior at the Freeman School of Business at Tulane University. Wow. So, and they're geeking out about the stock market. They compete. They're very competitive.
With each other?
With each other.
Okay.
And with me too.
Okay.
And they're coming up with these great picks. But I mean, honestly, if you look at their portfolios, it's crazy. Yeah. I mean, they're coming up with some amazing picks. And it's kind of fun that Tripp is also looking beyond just the AI, and he's just trying to get great stock picks in general. And so he actually follows all of Nancy Pelosi's picks.
Oh man, there's an app. Have you seen this app called Dub?
Oh yeah.
And it's the Pelosi tracker.
Yeah, exactly. So I mean, he's doing stuff like that.
Yes.
I mean, he's not just looking at just AI, but he follows Nancy Pelosi. It's hilarious.
So this leads to an interesting concept, because you basically got even nearly pre-internet, but definitely pre-AI stock investment newsletter. Now you have a post-AI stock investment newsletter. And we know that these factors, like, are they incorporating AI? You guys might even be using pattern recognition AI just to kind of make your picks and what's going on. So my question is more broad than that. How is the landscape different with you guys launching this newsletter than when you did it back when you were in Georgetown? What's the major sense of what's different?
I think what's different is there's a lot more individual stock investors. It used to be back in 1998, 1999. That's right when like E-Trade and Ameritrade was coming out, but most people were still having a financial advisor. Now what's happening is that those financial advisors only want accounts of $1 million plus, because that's they're going to make roughly 1 to 1.5% of an asset management fee for that account in general, and typically that's how it's done. There are other means to do it as well. And by the way, I'm not putting financial advisors down. I have 2 financial advisors that give me good stock tips as well, and I integrate them as well. But I have a lot of assets, and so they're wanting to have my business. But if you have just a few $100,000 or maybe only $50,000, you're not going to get their attention, right? So right now what's happening is a lot of those folks are now wanting to get into the game. They don't want to miss out. They've got a fear of missing out, right? Because frankly, they have missed out on a lot of the AI boom. If they had bought NVIDIA, 5 years ago, it'd be a very different time. But things are different. So you've got to figure out what's the next NVIDIA, right? So will Palantir become the next NVIDIA? What kind of stocks do we have out there right now? And what are the risks involved? So that's what we're helping people with. But I would say it's more exciting right now to be in the stock market than it was when I started smartportfolio.com. And because a lot more people are out there, and it's the information age too. I mean, it's easier to get access to research reports. It's easier to research companies. I can look at cap rates. I can look at PE ratios. I can look at things in just seconds. But it takes years of experience to realize, what am I looking for?
Yeah.
And that's what you got to learn. And that's what my MBA from Georgetown helps, and all my information with Smart Portfolio that I learned and throughout the years of just decades of stock experience.
I mean, you're making a good point because, you know, a lot of people come in and say, well, I could ask ChatGPT to get my stock picks. Why do I need to go with Smart Newsletter? Listen, for a fraction of what any of this learning cost you, you're getting your 25 plus years experience, your boys' experience compounded into this newsletter of, this is kind of what we're doing, just track our trades, you know, for all we care. As long as I've known you, wealth building seems fun, seems like play for you.
It is. And I'm at the level now where it's just fun. It's just fun. So
what is the most fulfilling aspect of helping other people with wealth building? Like whether at the agency, the real estate agency, or whether this newsletter, what's the most fulfilling part?
I've got actually a nonprofit that very, very little people know about because I don't really make it really known out there, but it's called Bridge the Gap. And it's with a friend of mine who used to be homeless, Brian Nash. And so he and I go out into the communities and we give out tracts, you know, different, you know, we give out the Book of John, we give out that like, you know, to a lot of homeless folks, people that are downtrodden. And I also help another lady who's in hospice care right now because she needs some money. So it's like, it's being able to put the money to use to do good things when a lot of people have no idea what I'm doing, right? So I'm not saying that to impress you, just to impress upon you that once you have the wealth, it's a lot of, it's very rewarding to be able to give it away in different ways. So, you know, I was one of the major donors to like Bonnet Springs Park here in Lakeland, and I didn't put a big flag on there saying, oh, I donated all this money, but it was just a great opportunity to give back to the community.
Looking ahead, what excites you most? What opportunities are you seeing as you look down the road the next 3, 5, 10 years that are true opportunities that you really get excited about?
I would say without a doubt AI.
Yeah.
So in fact, we just got back from the Keller Williams Mega Agent Camp, and Gary Keller has basically pivoted the entire company to AI.
Wow.
And so that was the theme of the entire conference: is artificial intelligence is here, it's real, and it's time to jump into it in the deep end, not just in the shallow end anymore. Let's really take a lot of the things that we do every day and automate them. So, but you know, the other thing I'm getting, which I want to be the first person in my hometown to get.
What?
I'm getting a Tesla robot in 2026.
Yes, the Optimus or whatever.
Yes, I'm getting it. So once I can buy that, I'm buying that. I don't think my wife is going to allow me to bring it home.
No,
because I don't think she wants it staring over her in the middle of the night. But I'm getting that robot. I'm going to have it down here at the office.
People don't know if these bots are more like Bicentennial Man with Robin Williams, or if they're like RoboCop. You know, like what am I getting?
What am I getting myself into? But I want to be an early adopter and get that robot. But I need it to do my laundry. So that's, if I can get it to do my laundry, man, that's game over.
Literally pick up, do the dishes, please. Like, you know, there's a band, and the title of the band says it all. The title of the band is "We Were Promised Jetpacks." And when we were young, when we thought about the future, we thought that robotics and AI were going to like simplify us, not make us work harder. So exactly, when the robotics come out, and we are seeing this with AI, this is the leverage. I think I just saw an article. Microsoft said, I think it was Microsoft that put out a report that they got rid of over 35% of their mid-level managers already.
Yeah, they did layoffs, and they're not hurting for business.
They're not hurting for business.
But just because of AI.
And so I think a lot of people have fear, because what if they're the ones who are displaced?
There's charts that you can see, like, if I go into this particular job category, am I most likely to be replaced by AI? And then there's other charts that say, hey, here are the ones that you can't be replaced by AI. And I think like number one was a phlebotomist, you know, the person that takes blood. That person's not getting replaced by AI because they got to be able to get the needle into you and take your blood, right? So there are going to be some jobs that are going to be pretty, but AI is going to change everything, and it's already changing everything. So it's just like the internet changed everything back in when everything was going public and everybody was getting on the internet, and it was a big deal. And AOL was, you know, you got mail, all that kind of crazy stuff back in the day, and all the discs they'd send you in the mail, and that's how the dial up, all that, all the free hours and everything. So that's all different now. But what we've got now is AI, and we can't ignore it. We've got to embrace it, and also just start monetizing it, make money off of it, and figure out who the winners are going to be and who the losers are going to be, and invest in them.
I'm meeting a lot of young people who are going into the trades. for the fear of white collar work and looking at welding, because this stuff is still a little ways off before we can replace all this, like you're saying with the phlebotomist. But what I see, and maybe you see the same thing or differently, I see nothing but opportunity then.
Sure.
Displacement,
it's an opportunity.
wealth transfer.
Correct.
What advice do you give new young investors in general? Across the board, stock, real estate. What's some advice you give new young?
There's a great quote from Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." And I've always remembered that quote when I'm investing. And I think what happens is somebody's new to investing, they're going to be late to the game because they get in on something that's already the good news is already baked into the stock. And so people are always like, "Oh my gosh, Nvidia went down after great earnings. That's so ridiculous." I'm like, no, Nvidia had a great run up to earnings. And then when the earnings came out, all the people was like, "Okay, time for profit taking, going to take my profits now." And that just happened, last week. So no big deal. Nvidia is an amazing company. It's still one of my strong buys. I think only great things are going to happen with NVIDIA. We just got to get the China thing kind of worked out and everything. But they'll make it happen because the CEO is very good with the administration, and we're going to make it happen. But be fearful when others are greedy, and greedy when others are fearful. And if you just keep that in mind, it is not a casino. The stock market is not a casino. It is a long-term wealth building opportunity. And so when you start treating it like a casino and you start trying to day trade and all that, if you don't know what you're doing, you could get wiped out. So what I'm trying to do is I'm trying to say, hey, let's pump the brakes a little bit. That's why this is a weekly newsletter. It's not a daily newsletter. We're not going to overwhelm you with information. We're going to say, hey, this is what happened 52 weeks out of the year. This is what happened in the stock market. That's enough for anybody. Not everybody can dedicate hours on CNBC every day. Not everybody can read their Wall Street Journal every day, know exactly what's going on. But what I can tell you is I do that. I always have the CNBC in the background. I always read my Wall Street Journal. I'm doing all that for you so you don't have to do that. And with the Smart Wealth newsletter, what's cool about it is it just gives you a snapshot for the week. And it tells you, hey, this is how Chris did, this is how Frankie did, this is how Tripp did. And then also we're going to start getting into Katie's stock trades too, because she wants to get into the game. She's getting a little jealous of her brothers.
The competition is alive.
Competition is alive. So we're going to have to see what Katie wants to do. So
you just gave a killer wealth building principle, and I'm going to stick with that. But what is one money principle beyond this greedy or fearful concept? Beyond that, what's one money principle you will begin teaching your grandkids?
The beauty of compounded interest. So the reality is, if you start investing and you set it and forget it in the right stocks and the right index funds, on doing the right things, you'll have the beauty of compounded interest, and your returns will multiply 10 times over. But if you don't have the time frame, you don't allow that compounded interest to come in and start taking over, you're going to be too short, and you're going to come up short. So you've got to let the compounded interest start taking over your stock investing for you. So that's a huge money principle, is compounded interest.
That's powerful. And I just thought about it. I think Alex Hormozi just said, if your cost per acquiring a client is set and your profit is just 1.1 times more than your cost per acquiring a client, you'll see compounded growth in your business immediately. That compound can't start early enough. And so if someone did want to start with you, where can they go check out the newsletter?
What they want to do is they just want to click the link below, which will take them to a offer page. It's only $97 a month. There's a money back guarantee. If you don't like what you're reading, if you don't like what we're doing, we just give you your money back. So there's no risk to the person that wants to invest in this. So it's $97 a month. Just click the link below, and it's Smart Wealth newsletter. We're going to take care of them too. So I don't know of any newsletter right now that incorporates both some real estate investing tips and tricks, and gives you weekly portfolio changes, and gives you exactly what we're doing with our portfolios. I don't know of anything that combines the two. That's why it's a wealth building newsletter. It's not a stock newsletter. It's a wealth building newsletter. So smart. And what I want people to do is do not just the stock market. I want them to also invest in real estate. So you should own your own home. There's benefits to that. You should lock in, a good rate. I know rates are a little high right now, but they're coming down. And you should also invest. You should max out your Roth IRA. You should do all of these things. But ultimately, the journey of 1,000 miles begins with a single step, and it's time to take that step. It's time to click the link and start your wealth building career.
Well, thank you for making your wealth experience and knowledge available to everyone.
Absolutely.
Me right
Yeah.
now, but also in the form of the newsletter. Thanks so much.
Thank you, Grant.